Welcome to the weekly deep dive video update where I look at charts that maybe I didn't cover all that much in the daily videos and also some other charts that are unique just to this video. We have to look a little bit deeper in these charts. That's why I call it the deep dive update because they're the things that we might be seeing are not really obvious, but we still could get some insight just by looking at these charts. This is being prepared for Monday, April 7th. Okay, we've been really going down with the markets, especially on Thursday and Friday. We were up on the week after Wednesday, but then all this tariff noise came out and it's really rattled the markets. And we saw a severe down day on Thursday and an even more severe down day with the S&P on Friday, with actually more weakness coming into the market than what we've seen. A lot of the weakness that we've seen up to this point has been rotation, just money going from one part of the market to the other part of the market, from growth to value. Well, there was actual selling, taking money out of the market in Friday's session, and that was quite a bit more negative. The VIX is really going up right now. It's not up into a higher range yet. We're still below 20 when we look at the 50 period moving average of the VIX, but it is really going up as the market's under pressure. Now, if we're getting ready to continue to go down, then this line is going to continue to go up. When the market is under pressure, the VIX is in a higher range typically. When it's in a lower range, that means the market is more positive and usually going up at that time. We also do another study of the VIX. It's the VIX with a correlation to the S&P 500. It spiked up a little bit here, but came right back down after Friday. When we pay attention to this chart is when we're above this dashed line. We're below it now, so we're not really seeing anything all that extraordinary here. And we really spiked up. You can see how the VIX really shot up in Friday's session. Well, we do the VIX with the ratio of the VVIX or the volatility of the VIX. And this just means that the VIX is going up faster than the volatility of the VIX, and that's usually more negative. And we've been seeing this rise right after we hit the all-time high back in the middle part of February. We've been seeing this going up as the market has been going down. And if we continue to go down, at least in this context, this line should probably still continue to go up. And so this is tending to be more negative. Also, we look at the skew index. Now, the VIX uses at the money options to be calculated. The skew index uses out of the money options. And we were up here in this red area for a long time. The market was expecting some kind of a big move that really didn't happen. And then we dropped down from that area and we're below the red area now. And even with all the volatility that we've seen over the last week, especially Thursday and Friday, this is not giving us a real high reading right now. You've got a lot of folks that are pretty confused, not really anticipating what direction the market is going to go, at least to the upside. A lot of folks are gearing things to go more to the downside. Then we look at the VIX, which measures the volatility of stocks, and do a ratio with the MOVE index, which measures the volatility of bonds. And when this is going up, that means stocks are much more volatile than bonds. And you can see how we've been really falling here, where bonds have actually been in favor lately. Folks are taking money out of the stock market, putting it into the bond market. So bonds are doing well, prices going up, interest rates are going down as stock prices are going down. Look at the large cap growth ETF. This is a major part of the overall stock market. When it's doing well, the stock market's doing well. It's not doing well now. It got hit over 6% in Friday's session and is really declining. We came back up to the 200-day moving average, which acted as resistance, and then we've been coming back down. And then you see Thursday's decline and then the gap lower and Friday's decline. We're also seeing where the shorter term moving average, the 50 period moving average, is now crossing below the 100. That's showing the more intermediate term trend has now turned negative. If we come down below these red lines, that's going to turn the long term trend negative. We need large cap growth to do well in a positive environment. If it's not doing well, then the stock market is pretty much not doing well at the same time. We look at a ratio between large caps and small caps. Sometimes we get some insight from this. When small caps start to outperform large caps, that can mean the end of a market cycle. Well, we're not seeing that now. Now, large caps have been getting hit, but small caps have been getting hit even more. So for the most part, least in 2025, we've really been going up with this ratio. Small caps are just really out of favor. They're in a downtrend right now. Mid caps are in a downtrend right now. And even though large caps are going down as well, they're not going down as much as small caps. And that's why we see this line going down. Excuse me, up. Then we just want to see where are we in relation to other major lows that we've set. Even with the pullbacks that we're seeing here, we're still up 45.2% from the October 2022 low. That was the major low that was set when we were really coming down and we were able to bounce up out of that. Now, as we were bouncing up, we did have a pretty significant pullback, which was in October 2023. And then we bounced up out of that and we're looking pretty good until we got about halfway through February in 2025. So we're still seeing gains in these areas, but we're giving back a lot of them lately. And when we go from the October 2023 low, we're still up 23.64%. We were up a lot higher than that. So these numbers are coming down, but they're still showing positive growth since those significant lows were set. Then we have technical alerts, and it's impossible to read this because so many alerts were triggered. These are for the whole week. Now you look earlier in the week, we see a lot of blue or green. That's positive. See some red here. Well, then we come to Thursday. We see an awful lot of red here, and all of this red that you see here, that's all Friday. These are technical levels that are being breached. These are indicators that are switching over negative, not only for the S&P, but different sectors and different indexes. And it just kept going and going and going. We start at the bottom and read this all the way up to the top. And this just confirms what we kind of already knew, that Thursday and Friday were really big down days, and a lot of negative alerts were triggered in the process. Then we look at 6 indexes and then rank them on a scale of 0 to 100. The higher the score, the better looking that particular index. None of the indexes are looking very good now, but still we have the Dow holding up the best. It's like the best of the worst right now. It's coming in with a score of 40. Now, the Dow is considered to be the bluest of the blue chips, the best stocks there are. There's only 30 stocks that make up the Dow. And so it tends to hold up a little bit better when the market is going down because there's growth and value in the Dow itself. But it comes in this week with a score of 40, which in and of itself is terrible. But it's the best looking index currently. In second place, also balanced with growth versus value, is the S&P 500, but it's quite a bit further in second place. The Dow is coming in at 40. The S&P is coming in at 26.5. There's a lot of growth in the S&P 500, and that's been really under pressure. Then, believe it or not, the mid caps, even though they're in a downtrend, they're holding up a little bit better right now. They come in third place with a score of 17. Then we have the Qs. This is the big growth area of the stock market. And this has all the stocks that everybody likes to own and talk about, like Google, Apple, Nvidia. Well, not looking so good right now because these stocks may outperform when we're going up. They also tend to outperform when we're going down, meaning they go down faster. And they're coming in at 15.8 right now. Then we have the NASDAQ itself. Now, this is the bigger index where the NASDAQ 100 is the 100 biggest stocks in the NASDAQ. This is the entire composite. This has recently been added to one of the indexes that I follow here. It's coming in next at 13.4. Then we have the small caps, which actually went up a little bit. We had a reading of 7. We were in the 6 to 7 range a week ago, just flatlining here, coming in at 9.9, and that's the weakest area right now. Then we have a short-term rainbow, just getting decimated right now. This goes from 10 periods up to 50 periods, dropping below all the lines. The lines are coming down. It looks like a waterfall right now. This just shows that the short-term trend is negative. Then in intermediate term rainbow, also negative because we're below all the lines. These lines move a little bit slower because this is a 50 period moving average up to a 100 period moving average. But this is also starting to come down, and we're also considering the intermediate term trend to be negative because we're below all of these lines. And here is the short-term trend, the 20 period moving average. I haven't been including this in the videos because we're so far away from it now, and the lines are coming down rather quickly. Also, I haven't been showing the 50 period moving averages because we're well below that, nor have I been showing the 100 period moving averages. Unless we start to bounce and come back up, there's really no need to show these charts. Then we have this thing called the Landry Light, and this just looks at the trend where even with the bounce that we saw early to mid March here, and things were showing some improvement, this never did turn positive. When it's green, we're going up. When it's red, we're going down. And then the longer the trend, the longer these lines become. This is a histogram that's continuing to grow. And yeah, it's still showing that things are quite negative. But we're getting that confirmation from other charts, so I haven't been showing this chart in the videos. This is a similar thing. It's called proper order. When the background is red, like it is now, that means we're going down. And then this is another histogram attempt to say, okay, this is how long this trend has actually been lasting. And it's still negative. The CMB composite, when we really were moving up earlier, I was actually showing this chart because we were extreme positive. We had a really good up day, and this really picked that up. Well, we've been declining, and even with the declines that we saw on Thursday and Friday, we still haven't gone extreme negative with this, so I haven't been showing this chart. And this is how far below now we are from the 200-day simple moving average. We're currently at 11.91% below the 200-day moving average. So we're going to have to really bounce to show some improvement. Another thing that we're keeping an eye on is this blue line. That's a 50-period moving average. And here is the 200-day moving average in red. If this blue line comes down and crosses below the red line, which can still take some time, this is when the longer term trend goes from positive to negative. So we're just watching this for right now. And this is more short to intermediate term. It's called a bow tie. There's a 10 period simple moving average that's in green. And since we're going down quickly, it's the one that's on the bottom and moving the quickest. Then we have a 20 and a 30 period exponential moving average. And this is like the rainbow charts in that when the green's on top and the lines are going up, that's positive. Well, when the green's on bottom and the lines are going down, that's negative. And we're still getting more confirmation of what's happening right now from other charts, so I haven't been showing this one. This is a 20 period simple moving average of the open, high, low, and close. When we were bouncing back up, areas in here were acting as overhead resistance. We were having a hard time getting back up through the rainbow as the little mini rainbow was coming down. And now we're way down here, well below this rainbow. So there's been no need to show this chart. We want to keep an eye on the S&P 100. That's the biggest stocks that are in the S&P 500. Not really seeing much of a divergence right now. The S&P 100 has been underperforming the S&P 500, and we're seeing that in other charts, but the S&P 100 is mainly growth stocks, and those are the ones getting hit. But we're not really seeing any real divergence here of price right now. They're all just going down together. Then this is internally, and I haven't really been showing many of the internal charts. Like this is a 10-day average of the highs and lows for the S&P because I haven't really been showing the advanced decline line either because it's been holding up. What we're watching mostly right now is price. And this is another internal measure that's a little longer term, and it's coming down, but we're still above 50. But this can take a while to turn more negative, and if we see more weakness or just as this chart itself adjusts, it's likely that it's going to go down below 50. That's the line between positive and negative. Then we look at the 19-day advanced decline ratio based on price. I show that chart in each daily video. We're below zero, but then I also have a version that shows the advanced decline ratio based on volume. And this is also below zero and declining. Not really hard to figure that one out. So I haven't been showing this chart. Then we have a long-term rainbow going from 50 periods up to 250 periods. We're well below the rainbow. The top part of the rainbow is starting to roll over. The longer we stay down here, the more damage this is going to endure. We're going to need to really come back up. And if we do go up, we'll be seeing if some of these other moving averages act as overhead resistance. But right now, we're quite a ways away from that even happening. Then this is a long-term oscillator called the Special K. That went negative in the early part of March. And that's kind of was giving us a heads up that the longer term trend is turning more negative. We're below the red line and we're going down. And so this is continuing to be negative. I don't show this chart because we don't get very many signals from it, but I do mention it in the daily videos. Then when we keep an eye on a weekly chart of the S&P, which has been going down, and now Germany's finally been going down too, but we're more neutral. We were seeing that the German market, that's the biggest market in the EU, it had been going up as the S&P was going down, and Europe so far in 2025 has been outperforming the US as far as stocks. But everything got taken down in Friday's session. It was more of a global decline. And so that worked its way back up a little bit with this ratio, but we're a little bit above the red line, but below the blue line. That's when we consider this to be more neutral. Then support and resistance. This is the Ichimoku cloud. Sometimes I call it the itchy and scratchy cloud. This is looking quite negative. We have price below the cloud here. A lot of times when we're coming down, this cloud will act as support. If we start to go back up, this cloud may act as resistance. There's also some studies on here that try to measure trend. The green line is quickly going down. That's the short-term trend. And then we see the blue line below the red line. That's negative, and both lines are going down. That's also negative. So this chart is quite negative right now. When we get further away from the cloud, I don't show this in the videos. I really want to see how we're interacting with the overall cloud. And really all this cloud is just current moving averages that are shifted forward. But they tend to sometimes act as support or resistance. Then some broad market measures. This is the VIXN, which is the NASDAQ 100 version of the VIX measuring volatility. And as the NASDAQ 100 has really been under pressure, this has really been going up both with the bar chart and the line chart. Since I focus mostly on the S&P, I look at this chart, but I don't use it in the videos very often because we're seeing what we need to see by just looking at the VIX. And this is a weekly chart of the QQQs, which is the ETF for the NASDAQ 100. One thing that I wanted to point out in this chart, you notice how we've been coming down. Lots of red. These are weekly bars coming down, but we're coming back here to this previous low that was set. Is there a possibility that we could find some support here? We'll be watching that to see if the Qs are able to bounce up off of that. Then we look at the QQQs in a different way by looking at a bar chart. We're well below the 200-day moving average, which is the blue line. And now the 20 and 50 period moving averages are coming down, and we're dropping below with the 20 and we're declining with the 50. And this is quite a negative looking chart at the moment. Then we look at the S&P 500 on top, and then we try to do a growth to value ratio here in the middle area. The Qs, which is growth, the diamonds, that's the ETF for the Dow. That's considered to be more growth. And they're all going down right now, but we see that the correlation between the top chart and the ratio in the middle area is still pretty strong. So we're not really getting any additional insight from this that we're not already seeing. Then we look at the Dow and the transports. The Dow's been getting hit, but the transports have been getting hit even more. That's the red line, as they really are underperforming. And then I've been keeping an eye on the financial sector. It got hit with everything else on Friday. This is the bank ETF to see, are we running into any problems with the banking sector? Now, one thing that's interesting is it got hit and it was down over 4%, but it's really hard to see. But we closed right about here where I have the pointer, where everything else closed at the lows for the day. So that's actually a little bit encouraging. We want the banks to look good and to actually hold up. But right now they are under pressure, well below their 200-day moving average. Another thing that actually showed some improvement, believe it or not, are the regional banks, the smaller banks, to the financial sector. It had really been going down, but you notice it closed well off of the lows in Friday's session. So that's encouraging. That's a little bit of positive thing that are coming into the market in the face of a very negative day on Friday. And then this is another broad market measure. We look at the Amex, the American Stock Exchange, the NASDAQ, and the NYSE, and then take a 5-period moving average of the highs minus the lows. This is negative. This is showing broad market deterioration internally. If we come all the way down to this red line, that's where we're considered to be extreme negative, but we haven't come all the way down there, at least yet. Then some rate of change charts going back over 250 periods. This is a shorter term chart showing how we're coming down and actually dropping below zero. That's turning more negative. Then this is a longer term chart going all the way back to 1980. And this is also starting to drop below the midpoint as things are turning more negative. This is more informational from a long-term perspective. And then let's see, didn't I already talk about this chart? Well, here we're going up with the large caps versus the small caps. Then we want to keep an eye on the German DAX just because it's been outperforming. You can see in 2025 it's really been going up. Well, now it's dropped down below its 50-day moving average, even though it's still in an uptrend. And a lot of folks are noticing that the European markets, specifically in Germany, are outperforming the S&P 500. And then we do a ratio between US stocks and German stocks. This has really been coming down, meaning US stocks were underperforming, bouncing around a little bit now as the German market has also been getting hit lately. Then we look at bonds, and this is actually telling an interesting story right now. One of the things that the market is really concerned about is inflation. Well, if inflation was actually happening and the bond market was being afraid of inflation, this ratio would be going up. And it's really been dropping. Now, some of this can be explained by this flight to quality, going from stocks into bonds, and bonds are going up as stocks are going down. Well, when we compare cash, that's money that you just keep with you, versus 3 to 7 year bonds. If the bond market was worried about inflation, this ratio should be going up and it's actually going down. So this is telling us, at least right now, that things are looking more deflationary. The prices are actually dropping instead of inflation where prices are going up because the CRB index got hit pretty hard this week too. And we look at tips, which do adjust for inflation and interest rates, and we compare them to 3 to 7 year bonds. This ratio should be going up. Now it's going down. Now, a week ago, it was going up, and we were a little bit concerned about that. But with the big down moves on Thursday and Friday, this ratio is actually coming down, suggesting that at least right now, the bond market is not concerned about inflation. And we're seeing that same thing here with tips and then looking at 7 to 10 year bonds. The ratio had been going up. Now it's starting to come down. Now we'll see how things adjust because Friday was one of those days where anything got sold, it seemed like. And so everything was going down. So as the week unfolds, we'll see if this ratio starts to show something a little bit different. But this is looking more deflationary right now. And then we look at the long-term bond, that's in blue, and then the S&P, where we're seeing that the correlation, they're having a tendency to go in opposite directions. And you can see that. The red line's going down, that's the S&P. The blue line's going up, that's the long-term bond. And you can see that they're going in opposite directions in the short term. Not much of a change with the longer term correlation, but it is decreasing lately. And we do that same basic thing. Instead of looking at the S&P, we look at the QQQs to the long-term bond. Although on this chart it's red. It's been going up as the Qs have been going down. And we're seeing the long-term correlation actually start to show some weakness as bonds are decoupling more from stocks instead of moving in tandem with each other. Then we take the 10-year yield in the US and subtract the German 10-year yield and plot it with the US dollar index. And as strange as it sounds, there's a pretty high correlation between this. We're not really seeing anything out of the ordinary right now. This just shows international currencies against each other with the dollar itself, excuse me, international interest rates with each other, and then the US dollar index showing that there's a pretty high correlation between the two. And we're keeping an eye on the 2 year Treasury yield, which is dropping here a little bit, but that's really not giving any support to stocks right now. Not really giving us all that much insight. Then the Eurozone, which had been doing quite well and outperforming 3 to 7 year bonds, well, it's really dropping down and we fell below the rainbow as everything got hit pretty hard on Friday, even in Europe. Then we're looking at some possible positive scenarios. We're not quite there yet. We are oversold right now, but this is that same chart, the 10-day average of the highs and lows. It's coming down, but still above 50. And then this is getting close. This is where we use this like an oscillator. These are the S&P 500 stocks above their 50-period moving average. Right now, 11 is the score. If we drop down below this, this is when we use this as a contrarian indicator and we look for a possible bounce. We still have a little ways to go before we get to that. This is more intermediate term. And then we look at the mid caps, it's already below the red line. So now this could go even lower than where we're at right now. And we could actually sit down here for a little bit. But sometimes when we see this kind of a reading, that might show a little bit of a bounce, at least with the mid caps. And then we're also below this red line with the small caps. So if we do get some kind of a bounce, we'll be watching to see what is the quality of that bounce. Is it just a dead cat bounce where we're wearing off a lot of the overreaction in Friday's session before we get set to go lower? That's one scenario. Or if we bounce and really start to show some strength back to the upside, that'll tell a different story with the possibility of things turning back more positive. So thank you. I hope you have a great weekend, and I will talk to you in the next video.